your take on the quarter, what stuck out, maybe what didn't.
Sure. Good morning, Brian. I would say results were somewhat better than we expected, for sure. But the real focus was on sort of Bob Iger's vision of the future and of Disney. And I think, as you said, cost cutting was a major focus. He outlined $4.5 billion in new cost cuts that are going to take place over the next few years. And he also offered a streamlined version, I would say, of his streaming D2C service.
Okay, what can you tell us about Disney Plus, about ESPN? I saw some reorganization, but it sounds like ESPN will stay. It's not going to be spun off into a separate company. He said it was going to stay, but what are they going to do about streaming? I mean, is Disney Plus going to cost our viewers $20 a month soon?
It may. Definitely pricing was one of the areas that they addressed. They think that services are, I think, across the board between ESPN Plus, Hulu, and Disney Plus are underpriced. I think they're going to reevaluate their spend on general entertainment. So, they really delineated between sort of core Disney, which includes Star Wars, Marvel, Pixar, some of the classic Disney, and what they're doing on the general entertainment side. And I think they're going to roll back some of the spending there. And I think that's really where that $3 billion of that $4.5 billion came from. But yeah, streaming is still the future of this company. But I think, similar to other traditional media companies that sort of went all in on streaming to sort of chase Netflix, I think what you're seeing is sort of a bit of a reversal from all these companies now. And we saw the same from Disney last night. So still the focus, but I think profitability, comes back as really the main focus of the company.
When will Disney Plus be profitable? I mean,
yeah,
heck, when will any of these streaming services be profitable? I'm asking for a friend, John.
Yeah, so each one of these companies is on its own timeline, right? Bob kept the guidance, effectively maintained the guides for the D2C business being profitable by the end of 2024 and profitable for the full year in 25. I think there are some efforts to reaccelerate that. Again, they cut content spend really on sort of non-sports by about $3 billion or sort of 15-16%. I think some of these other companies are going to follow. I would expect you're going to hear something similar from Warner Brothers in a couple weeks, maybe even Paramount. I mean, I think what often happens in Hollywood is Disney sort of leads the trend, and I think they are setting the stage for further cuts as we look out over the next few weeks.
And gosh, I forgot that Disney actually has, theme parks, Disneyland, Disney World. How are they doing? And what's the recession risk? I mean, we know these parks, listen, you take your kids because they want to go, you spend the money. But with savings being drawn down, you wonder if families are going to be able to go and spend, $1,000 a day at these parks.
Yeah, and that's the worry and part of the pushback we hear from our clients. Parks crushed it. Domestic parks margins 35%. It's the highest we've seen in a number of years. You had double-digit attendance growth, high single-digit per cap spending. They really did extremely well. Bookings seem very strong. But you're right. As you look out, a few quarters, the outlook looks a bit hazy. But I'd say right now, they're doing phenomenally well, as are the parks at Comcast. I mean, the parks business itself is doing extremely well.